Hello, everyone. So welcome to today's lesson. My name is Miss Marie, and today we're going to discuss investment appraisal. This is a topic from the Business IB Business Management course that's included in the Finance and Accounts unit of the syllabus. It has a little bit of an overlap with economics as well, and I think it's just a fascinating subject overall. So a little bit of housekeeping items. You will need for today's lesson calculators, so please be prepared. Also, you will have a link to the slides that I'm going to show to you today, and you will also have a link to a workbook that we're going to use today. So please have it ready because we're going to work a lot with the workbook. So let me share the screen with you. Just a second. Okay. There you go. Okay. So today we're discussing investment appraisal, so analysis of investment projects. And let's just a note, I like this quote by Benjamin Franklin, who said, "An investment in knowledge pays the best interest." Keep that quote in mind. We'll discuss it shortly, okay? So let's just go by learning objectives first. So in IB syllabus and the what do you have to know for your exams? So you will have to know how to analyze and calculate investment opportunities using 3 methods: payback period, average rate of return, and net present value. So the first two, the payback period and the average rate of return, are for everyone, for SL students and for HL students. The NPV, the net present value tool, is for HL students only, and that's the one that we're going to focus primarily today. So today's lesson would usually come after the previous lesson, where we would do an introduction to investment appraisal, and we would study the first 2 tools. You will also have to not just learn how to calculate how to analyze your investment projects using these calculations, but you would also have to understand how to discuss these results and evaluate those results. We'll get there towards the end. So what's the plan for today? First, we'll do a little of introduction. We will do a quick revision for the payback period and average rate of return methods. We're not going to go in details about them because we would have studied them before the previous lesson. We'll just do a quick revision so you remind yourself of what those are. Then I'll introduce you to the concept of time value of money, a very important concept that is also used in economics a lot. We'll learn what is compound interest. We will learn what is discounting. Then we would also learn about the net present value, the tool that we're going to use. We will do some calculation examples, exercises. We will learn how to evaluate the results. And towards the end, we will have a link to TOKs, a little debate. I would usually have it with a bunch of students, but I will have it with you indirectly, hopefully, today. Okay. So let me right away show you the workbook that you should also have prepared for today's lesson. So that's the workbook, okay? That's the workbook. And you could see here that there is on the first page, there is a table where you could use it for your notes. So you have all 3 tools that are required by the IB: payback period, average rate of return, and net present value. You would have to know the definitions of each of them here. You can put them in there. Units of measurement, percentages, rubles, years. We'll get there shortly. The formulas and the pros and cons. So you could use this workbook for your notes, okay? And there are plenty of exercises that we'll do after that. Okay. So first is the key question. What do you understand as an investment? What is an investment for you? So remember the Benjamin Franklin's quote that we just had. Education is a sort of investment as well, right? You're investing your money and time and effort into getting an IB diploma or university down the road to get that excellent education, which will pay you off later when you hopefully are going to get a good job, or maybe you will run your own business, having all of this knowledge that you've accumulated during this time. You could think of investment. Many people link investment with stock market. So investing in stocks, investing in bonds, maybe cryptocurrency or something like that. So that's also sort of investment. Ladies like to think of investments as even makeup or clothing. Like, hey, I've bought this dress, for example, and I wore it hundreds of times, so it was a great investment. However, when we speak about investments in business management or economics, we refer to purchasing of capital goods. So the examples could be we're buying machinery for our factory, maybe new computers, maybe we are investment in R&D for new products. So for example, think of pharmaceutical company that has this great idea of developing a new vaccine. It's still a huge investment. It's billions of dollars. I used to work with pharmaceutical companies, so it costs a lot of money to come up with a new pill or new medicine. And it will pay you down the road when this medicine, for example, will get approved and will actually be for sale. Same with computers or new office, new location, new product, so on and so forth. Okay, so investment appraisal is the analysis done to consider the profitability of this investment. Okay, this evaluation could be quantitative, so you would have to calculate the finances, right? Or qualitative, so you think about strategic fit of this project with your business. So we'll first start with quantitative analysis, and we're going to focus primarily on quantitative, but we will also discuss the qualitative considerations as well. Okay. Okay. So let me erase that. It was me testing the platform. Okay. So what are the methods for quantitative appraisal? So there are quite a few of them, but let's see only those that IB uses for the course. So they're non-discounted cash flow methods, and they're discounted ones. The non-discounted cash flow methods do not consider the time value of money, the inflation, and we'll discuss it in a second. And we would have studied this the previous lessons. So the payback period and the average rate of return. And if you look at the workbook, you could see them here. Okay. And there are quite a few of discounted cash flow methods, the NPV, the IR, and so on and so forth. But for our course, for passing IB exams, you only need net present value. Okay, so you need to know the payback period and the accounting / average rate of return. There are different literature that uses different terminology. Okay. What do you need to consider? What do you need to know in order to do your analysis of an investment project? Of course, obviously, you need to know what is the initial capital. So if you're purchasing computers for your office, how much money do you need to invest in this project? You need to know the life expectancy, so the timeline of this project, okay? You need to know the residual value of your investment. What does it mean? It's also called a scrap value. Okay. So for example, you want to buy a whole bunch of cars and you want to open a taxi line, okay, taxi line for your business. Obviously, these cars, they will have a certain timeline of their life, right? So once they're done, for example, it's 5 years, is there any value in residual value once these cars have been used for 5 years? Can you sell them for anything? That's your scrap value. You need to know the forecasted net cash flow from the project, which is cash inflow minus your cash outflow. That would be your expected return from the investment. And for our NPV tool that we're going to use to study today, you would need to know discount factors, and we'll get there today as well. Okay. So just a quick recap on payback period, which we would have studied the previous lesson. So the payback period is very simple tool. It's basically the length of time that it takes for the net cash inflow to pay back the original cost of the investment. And there is a great example here. So Virgin Atlantic is an airline, invested 200,000 pounds in the new technology communication system. This system earned extra cash flow off the original 200,000, so more than 200,000 in just 3 months. So it's a very rapid payback. So what you could also say that this investment project has recouped its original investment amount of 200,000 pounds here after just 3 months. It's a very, very short payback period, okay? Obviously, the longer the payback period, the more risky and inaccurate these forecasted cash flows are. Also, if you think about that, if the business borrowed this money from the bank or from venture capitalists or something like that, the longer payback period is, the more interest payments you will have to make, right? The positives of payback period, it's very simple. It's very easy to calculate. It's very easy to explain to business owners if you're a business manager or you're a business consultant. It focuses on liquidity. So when am I going to get my money back? That's actually the question that you're answering with this question, with this method. But the negatives are that it does not consider any profitability. You don't know how profitable this project is. The only thing you know is when you're getting to get your money back. It also concentrates too much sometimes on short-term projects. And if you just focus on payback period, you might disregard some longer-term projects that could potentially be much more profitable. Okay. The next tool that we would have studied previously was the average rate of return. It's a measurement of profitability. So if we in a payback period, we measure time, and see here you have it, years and months. In average rate of return, you measure percentages. So it's a percentage. It's a percentage of return, essentially. It's how profitable your project is. This formula will be given to you by IB in a formula sheet, which is right here. So you don't need to memorize it. An example is, suppose we're considering a purchase of new equipment, which is worth $300,000. Based on our calculation, we're not going to do that today. We would have done it the previous lesson. The ARR is 17.7%, while the central bank's interest rate is 5%. So you could see here that the project seems very attractive because the return on the investment is more than 3 times as large as this criterion rate that we've used, okay? So if we have borrowed money, this $300,000 from a bank at 5%, and we earned almost 18% from this project, that kind of potentially means that we've earned 13% of profit from this project, which is a great profit. I think you would agree with me. Some companies also develop their own internal benchmarks for AR. So a business owner might say to you, I won't do any investment projects that would bring me less than 15% of AR. You could hear something like that, okay? So the positives of average rate of return is that it focuses on profitability. It's very easy to calculate and explain. Most of business owners know what that means. The negatives is that it ignores the time value of money. It also ignores the payback period. So this tool is often used together with payback period and with NPV. Okay. Which brings us finally to the time value of money. Okay. Suppose that I owe you $1,000. Would you choose to receive this payment today, or you would choose to receive this payment in a year from now? What's your choice? I suppose you said, give it my money today. Why? Why so? Well, there are many reasons, right? You could spend this money today and enjoy whatever it is that you've bought with this money. You could save this money in a bank and receive a profit from it. You could reinvest this money. Also, you need to consider inflation in your country, for example, in Russia, and think, okay, well, in a year from now, I could buy less products on the same $1,000. So why would I choose to get them in a year from now, unless there is a return on this investment, right? So also, the longer you have to wait for your payment to be received, there are more risks associated. Something could happen. For example, God forbid, I could lose job and not give you this $1,000 in a year because I'm sorry, I don't have it anymore. I had it a year ago, but I don't have it now. Or something else could happen, COVID, whatever. There are plenty of reasons, plenty of risks. And the more your payment is delayed, the more risks there are associated with the time. So that brings us with the concept of compound interest. Okay, so suppose if you can save, okay, if you can save $1,000 at 10% of interest today, next year you will have, simple calculation, 1,100. So that means that 1,100 in 1 year is the same as 1,000 today, but at 10% interest rate. So that 1,000 is called present value, and that 1,100 is called future value. Let's make let's do another example, and I put the Canadian $100 here, just because I think that our currency is pretty okay. So let's say that we have this $100, this $100 that you see, and the interest rate of the central banks, let's say of Canada, is 5%. Okay, so if you put, this is our timeline, and I really like, sorry, I will do it once again so it's a bit more straight. I really like to use timelines, just started from my university, and I find that they help me a lot. So let's say that it's 2 years now. Okay, so 1 year here, this is today, and this is 2 years. Okay, so I put my $100 today. This is my present value, and I keep it in the bank for 1 year. How much are you going to get here at 5% interest rate? Well, that's very simple, right? You just multiply $100 by 1.05, and that will be 105 here, right? But what if you keep it there for 1 more year? What's going to be? How much? Well, there is actually a formula for that. You don't need to memorize it. I'm just trying to explain the concept. The formula is the following. So you would have your original investment, your $100, multiplied by 1 plus interest rate to the power of your years. So here it would be $100 multiplied by 105 to the power of 2. Okay, and that is $110.25. Okay. So this is called future value, and this is called present value. Does this make sense? So now let's suppose that you know the future value. You're given with a project, okay? You're said, you will be said something like, here is the business project. You will receive 100,000 in 3 years. How do you know how much this 100,000 is worth today? So for that, to find that out, you need to use the opposite of compound interest, which is called discounting. So opposite of compounding, okay? Discounting is the reverse of calculating compound interest. It's a method of reducing the value of your future cash flow from business into today's terms. Obviously we need to know interest rates for that. So let's say, suppose that you know that in 3 years you will receive from your business project $100,000. 3 years, and the interest rate right now is 8%. Okay. So how do we find it out? We need to know something that's called discount factor. And I want to warn you, you do not need to learn and memorize how to calculate those discount factors. You will actually be given a discount. Hopefully you can see that now. You will be given with discount factors at the exam. So don't worry about it, okay? But I want you to understand how it works, okay? So I like, again, to draw my timeline. And this is 3 years. Here we have today. It's 1 year here and 2nd year here. So over here, our future value of $100,000. How do I discount that into today? How do I do this? How do I find out how much is it worth here? Well, you need to multiply your future value by the discount factor. And let's check it out. It's 3 years and 8%. Let's go, actually, I have it on the next slide. So this is from IB Guide, and you will be given either with this formula or this table, or you will be simply given with the discount factor in the question. So no need to worry. But let's do it together. So this is the 8%, and this is the 3 years. That's your discount factor, 0.7938. Okay. So let's do it. Multiply 100,000 by 0.7938. And obviously it's equal to 79,380. So that is the present value of the profit of $100,000 in 3 years from today. Okay, so this 100,000 is worth 79,380 today. Hope that makes sense and explains a bit better. Okay, so the discount rate is this figure that's used to reduce the future value of money towards today's money. Okay, we needed to establish the present value of cash. How do we get to these discount factors? You do not need to calculate them at the exam. I just want to reiterate it once again, okay? No need to calculate it. But I want you to understand how do we get there in order for you to understand how do they influence our cash flows? Okay, so the way we calculate it, and yeah, let's use the same example for simplicity. So it's 8% interest rate and 3 years of timeline. Okay, so how do we get there? How do we get the discount factor? So a discount factor is going to be equal to 1 over 1 plus your interest rate time to the power of your time. So in this case, it's 1 over 108 to the power of 3, and that is your 0.7938. You can check me on your calculator if you don't trust me. Okay, and that's exactly the number that's used in the table. Okay. The reason why I wanted to know that, because like, why, if we don't get this question on the exam? Well, you need to understand that this discount factor obviously depends on the interest rate and on the time. And because both of them are located in the bottom of the fraction, so they are located on in the denominator, they work. The higher both the interest rate or the time is, the less value your money in future will have. Actually, let's see it on the table. You could see here that when it's just 1 year, so you just need to wait for 1 year for your money. When the interest rate is low as 4, it's very close to almost 100% of your future payment, right? So 0.9615. However, if the interest rate is very high, like 20%, you could see how much lower the present value of the future cash flow is. Similarly, if we increase the time that we need to wait for our payment, you could see that even with a low interest rate of 4%, the present value diminishes to 0.6756, right? And if we take 10 years and high interest rate of 20%, the present value of the future cash flow is so low, it's just 0.1615, right? So it's almost 16% of what this money is worth today. Okay, makes sense? So that, I want a little bit to pause here. You probably know the America's Got Talent show, right? So what's interesting about them is you probably know that the winner is supposed to be receiving $1 million, right? So you can go to America's Got Talent, and if you win it, you're supposed to be receiving $1 million of prize. However, the producers of this show are very clever. So what they've done is that they have a disclaimer on the contract with their participants, and the total price is actually payable in 40 years annually. So it's like financial annuities over 40 years of time. And this is just $25,000 per year. And also, if you take the taxes out, if you apply the interest rates, if you apply the time value of money concept, if you discount those cash inflows towards the time today when this participant has won the competition, in reality, he's just won $375,000, not 1 million. And it's just an interesting case. And also what's curious is that the cost of that's approximately the cost of a 30 seconds advertisement during the show. So you could see how these producers, they're very clever. They obviously know the time value of money concept, and they knew how to apply it to their business, because it's also a business. Okay, so let's now get into the net present value. So that is an HL only tool that is very, very often included in paper 2 exams. Actually, almost every year there is an NPV that has to be calculated. So a net present value is a method of investment appraisal that calculates the real value, not the absolute value, the real value of these investment projects by discounting the actual money that's received in future. Okay. How to calculate them? Now, again, don't be scared. You don't need to memorize this formula. This formula, as it is on the slide, is actually going to be included in your formula sheets that are going to be given to you during the exam. So you don't need to memorize the formula. And again, you don't need to memorize the discount factors, okay? But you need to understand them to be able to apply them. So let's see. What you need to know. Suppose you have a project that would have a multiple receipts of cash. So you invest, oops, excuse me, let me draw it again. You invest today some money, right? And you have 3 years again. So you would have some receipt of cash here, some here, and some here. There's some cash inflows from your investment project. What you would need to do is you would need to discount all of them into today using your discount factors. And then you take these X, Y, and Z values, you sum them together. So you sum them together. So this becomes the present value of all of these returns, and you take out the original investment. Original cost, original investment, principal, there are many words that mean the same thing. If this NPV value is positive, that means that the future discounted cash flows are enough to justify the investment. Means good, go ahead with this project, okay? If the NPV is negative, that means the project is not profitable and it's not worth pursuing, okay? Let's do an actual example. I think it will make it easier for you to understand. So let's say we have an example with the original $10,000 of investment. Let's just start with drawing our timeline. You don't have to draw the timeline for your exams or for you in general. It's just much easier to me personally to understand the concept. And also when you are in your universities, you will see that these calculations become even more complex. So these timelines really help with not being confused anywhere. Okay, so this is 0 is today, first year, second year, third year, and fourth year. So today, what I'm doing, I'm investing $10,000. Let's say that I need to buy computers for my firm. What kind of cash inflows are there? So in the first year, I will receive $5,000. In the second year, I will receive $4,000. In the third year, we will receive $3,000. And in the fourth year, I will receive final $2,000, after which my computers will have to be sold or something like that. Let's not discuss that at this moment. So what do I need to do? We need to, as I said already, to discount these values, okay? I've already taken the discount factors from here, these ones. So because it's 8%, I've taken all of them into here. So you don't need to look them up. And you bring them towards today using these discount factors. So here it's 9259 and so on and so forth. So it's easy to do it with the table as well. So you just take 5,000, multiply it by the discount factor, and you will receive this this much. So 4,630. So this is the present value of your future cash flows. Okay, do the same here, here, and here. And then you take the sum, so you sum all of these discounted cash flows together, these ones, to come up with the cumulative amount of $11,910. So that is your total discounted cash flows over here. Then obviously you need to subtract your original investment of $10,000 to come up with NPV, which is in this case $1,910. What kind of conclusion can we make here? We could think that if this money, if this original investment of $10,000 is borrowed from the bank at the rate of 8% or less, this project is clearly profitable, right? So on the top of our original investments, we are receiving $1,910, and that accounts for the cost of borrowing of these funds. Okay, let's do one more exercise, and I want you to work on it by yourself. So suppose you have a large manufacturer that is considering whether or not to spend the $800,000 to upgrade its management information system. Pretty expensive, right? It's an expensive project, but you have quite a lot of cash inflows. It's a 5-year project, and you can see the cash flow projections over here. I've already included the discount factors for you. Here we're using 10% interest rate. So once again, what you need to do is to multiply these values to come up with the discounted cash flows, then sum them together to come up with a total, and then subtract your 800,000 original investment to come up with NPV, and decide whether or not it's worth pursuing this project. You can pause this video right now and make your calculation. I will also pause this video and just to write, I will write the answers for you. Okay. Let's figure out how to do that. Pause. Welcome back. So what did you get? Well, I hope you got a positive number because it is indeed positive. So what could you see? These are the discounted cash flows. And then this is the total. And to come up with NPV, the net present value, you take the total of the discounted cash flows, you subtract your original investment of 800,000 to come up with the final NPV of 243,560. You could see clearly that this is a positive number, which means that if money can be borrowed, and you need to learn how to interpret these numbers, right? These results. So if this money can be borrowed at an interest rate of 10% or less, the project is clearly profitable. So you could go ahead and invest this money. Okay. So I want you now to go and to do, let's do it together actually. Let's go to our workbook and let's do this compare two projects. This often also comes in IB exams. They want you to have where they could give you two projects, and you would have to decide based on various criteria, which would include NPV, usually for IHL students, on whether or not to pursue one or the other. Okay, or you select one. So what do you see here? Hold on for now. So calculate the net present value by compiling the table below. Discount factor is 6%. In this case, you are given already, as I said, in your exams, you will be given with discount factors. No need to memorize how to calculate them. So you're given with discount factors. And the original cost is 300,000 for both projects. So again, I will ask you to calculate the project Colorado and project Detroit. So for example, you're given with the, you're opening a new shop, and one would be located in Detroit and another one is in Colorado, and you only have $300,000 to play with, so you have to select one or the other. Okay, so start your calculations. Once again, you multiply your net cash flow by discount factors to come up with present values of these cash flows into today. Then you sum them together to come up with NPV. Well, you obviously will need to subtract your original investment of 300,000. I will pause this video. You can pause this video as well. And please do it for yourself, and we'll compare our results. Welcome back. Okay, so let's see, what have you got? So first of all, let me say that total, both projects, if you just look at the actual values, not the present values, but the actual receipts, cash receipts in future, both of these projects look to be the same, right? So both of them would total with a receipt of $550,000, right? So it looks like they're very similar, like they're almost identical. $300,000 investment versus $550 receipt of cash flows. However, because of the time value of money, because of the discounting of these cash flows, and because of different schedule of receiving these cash inflows, you could see that the results are actually different, right? So for Colorado, so if we open our shop in Colorado, the NPV is $162,510. However, if we open our shop in Detroit, we would actually receive more of discounted cash flows. So 179 and 865. So you could see that the actual delta, so the difference between these two projects, is actually $17,355, or it's actually more than 10% difference between the projects, right? So the Detroit projects is actually more profitable, 10%, more than 10% more profitable than a project in Colorado. Also, what you could see here, and we didn't calculate, I didn't ask you to calculate that, but you could see that because in Colorado, we do not see most of the return until almost towards the end of the project, right? While with Detroit, was right away from the first year start receiving a bulk of the cash inflows, or the bulk of profit. So not that much money is lost due to the time value of money. So the payback period for the project Detroit is also shorter. We haven't calculated it, but I think you could see already that in 2 years you would get 300,000 back. So your payback period is 2 years here, while with Colorado, you would actually receive your full, you would recoup your original investment during the 3rd year. So in fact, it's 2 years and 9 months. So considering quantitative appraisal methods, clearly the Detroit project is more appealing to you. It has a higher NPV. It has a shorter payback period. We haven't calculated the ARR. It's going to be the same because the ARR does not consider the time value of money. But from quantitative perspective, it looks like the project Detroit is more appealing to us. What about the qualitative analysis? What about various considerations of gut feeling or intuition, or maybe there are certain other things that a business manager must consider? Let's see. So what are the qualitative appraisal parts? So it could be, for example, the impact of on the environment of your project, the planning permissions or the building permissions, the organization's missions and vision statement, the corporate culture, the aim and objectives of the business, what maybe the business really wants to grow around Colorado. Maybe they have a certain vision, and in that case, they might prefer the other project, even though it's less profitable. The external risks, obviously, the COVID and things like that, ethical consideration and reputation. And I want to give you an example. In 2006, Manchester United Football Club voted against a sponsorship deal which was worth around $100 million, or about 700 million British pounds, with a company that's called Mention. And this company is an online gambling company. Oh, the deal was extremely profitable, very lucrative. However, it went against the ethical principles of the club, and they didn't want to have the repercussion of potentially hurting their reputation as well. So I hope that you could understand that you don't just consider the quantitative measurements of investment appraisal, but you also need to consider the qualitative ones. And before that, we end with our TOK debate, just very quickly. What are the positives and negatives of the NPV method? So the positives, of course, the NPV, the net present value method, considers the time value of money. So hence you understand what really these future cash inflows are worth today. The rate of discount can be varied according to the different economic circumstances. And it also considers the opportunity cost of money that you would have to invest. What are the negatives? Well, NPV is a fairly complex method to calculate and to explain to certain business owners. You would have to be able to explain what that means, what time value of money means to the owner of the business. The final result depends very much on the discount used, and the expectation about the interest rate might not be accurate. So, for example, right now the interest rate in Russia is 16%, and there are debates whether or not the Central Bank of Russia would increase the interest rate to 18% or not, or whatever. We don't know exactly, right? So that has to be taken into account. And if the business has to borrow the money, and if the rate is floating, not fixed, it might obviously affect the business. The longer the duration of the investment, the more uncertainty there is. We don't know what's going to happen even tomorrow. So how do you know what's going to happen in 5 years or 10 years from now? And NPV can be compared with other projects only if the investment is the same, because it does not provide the percentage of return. So now, we already discussed the various qualitative appraisal considerations. I've given you the example of the Manchester United Football Club. And with that, let's finish our lesson with the link to TOK. And usually at this point, we will have a debate with my students. So do you think, is there ever a case for a profit-seeking organization, not charity, not social enterprise, the profit-seeking rational organization, to ever pursue a project that has an expected negative net present value? So you as a business owner know that this project is just not profitable. Its NPV is negative. Would you ever consider pursuing with it as a rational, profit-seeking business owner or business manager? And I'll give you a little hint here. Is there ever any sort of strategic considerations that you might have in mind that you would be ready to pursue a non-profitable project? And please think about that. Let me know. You can put them in comments or whatever. Reach to me and let me know what you think about that. I've prepared a homework for you, of course. So the homework is in the workbook, and it would be this core new gym project. So please do this exercise and send me your answers. And in the next lesson, if we have it, we will do various exercises considering all methods of investment appraisal that we have studied. So payback period, average rate of return, and NPV for HL students only. We will do a couple of exercises. And for those of you who are watching this video. I've also prepared a summative assessment on this topic, and I will share the link with you separately. Okay. Well, hope you enjoyed this lesson. Hope you learned something new. Please let me know your thoughts on the last question, the TOK debate question. I'm very curious to to find out what you're thinking about that. If you have any questions, please don't hesitate to reach out to me. And have a wonderful day. Bye-bye.